Welcome to This Explainer. Over the next 5 minutes or so, we're going to conduct a high-level board briefing on the legendary market speculator, Jesse Livermore. We're going to take his famously chaotic 1940 memoir and distill it down into cold, actionable rules, looking at it specifically from the perspective of a modern professional financial manager. We are anchoring today's deep dive in some really brilliant analysis by the namnnt channel. They put in the work to decode the dense original text of how to trade in stocks to uncover these timeless institutional-grade lessons for us.
All right, to make that leap from amateur speculation to institutional-grade management, we'll be covering 5 key pillars today: professional management mindset, capital risk principles, the discipline of timing, capital deployment strategy, and finally, the winner's truth. Let's get right into it.
Section 1, Professional Management Mindset, From Chaos to Clinic. Look, we have to face the stark reality that managing capital is a cold, calculated business. It is absolutely not a place for thrill seekers.
The core difference here is practically night and day. An amateur gambler, they want fast money, they rely on luck, and they act on impulse. You, however, must approach your portfolio with the clinical precision of a brain surgeon. You have to operate with strict discipline, rely entirely on observation, and value capital protection above everything else. Think about it. You wouldn't ask a surgeon how to make a quick buck at a casino, right? So please don't treat your life's capital that way. Section 2, Capital Risk Principles, the Psychology of Survival. This part is fascinating because it actually requires us to completely invert our natural human instincts. It turns out your natural emotions are entirely toxic in the market. Just look at a winning position. The amateur feels fear. They sell out early just to lock in a tiny little gain. But the professional, they feel hope. They let that profit run to maximize their returns. And then flip it. In a losing position, the amateur hopes for a rebound. The professional feels pure fear immediately and just cuts the bleeding right then and there to protect the capital. And that brings us to strict adherence to stop-loss protocols. Livermore had this incredibly famous saying, "I will not stand and argue with an express train." It makes total sense. When the market flashes a massive danger signal, like a sudden drop on super high volume, you don't stand on the tracks trying to figure out the logical reasons in the news. The news is going to explain it tomorrow when you're already bankrupt. You just get off the tracks. This leads right into the absolute golden rule of capital preservation. Never, ever average down. Say you buy a stock at 50 and it drops to 47. You are wrong. End of story. Do not throw healthy money at a sick position just to lower your cost basis. A failed speculation should never magically morph into a long-term investment just because you don't want to take the loss. Oh, and margin calls? That's a death knell, guys, not an invitation to borrow more money. Section 3, the discipline of timing, the power of patience. Preserving your capital is deeply tied to knowing exactly when to sit on your hands and do absolutely nothing. Livermore called this the psychological time. It means waiting patiently for undeniable market confirmation before committing a single cent. Picture a stock just chopping around, stagnant between $25 and $28. Amateurs will buy at $25 hoping it goes up. The professional waits for it to break out to a brand new high, say $30. Sure, you might pay a slightly higher price, but buying at that breakout is the starting gun. It signals the trend is actually confirmed, and it saves you from months of exhausting, aimless waiting. To pull this off like a professional manager, you've got to tune out the daily noise and media static. Honestly, your personal opinion is basically worthless until the market validates your thesis. You always want to require dual confirmation from industry leaders before making a move. Livermore always tracked sector leaders in pairs, like US Steel and Bethlehem Steel back in his day. If one breaks out and the other doesn't, it's a trap. Don't fall for it. Section 4, Capital Deployment Strategy, Sizing the Trade. Let's look at exactly how a pro allocates capital once the timing is finally right. This is known as the inverted pyramid strategy. First, you test the waters with a small initial position, maybe just 100 shares. If the price drops, well, you were wrong, cut the loss immediately. But if the price rises, the market is officially confirming your thesis. That's when you add to the position at the higher price. You are only ever building massive positions on a foundation of profit, which keeps you in control while completely minimizing your downside risk. Section 5, the winner's truth, protecting the portfolio. Because let's be real, the ultimate goal of a financial manager is actually keeping the wealth you generate.
50%. This is a hard, unbreakable rule for cash management. Whenever you secure a massive profit, you must immediately withdraw exactly 50% of it out of the market and put it into cold, hard cash or physical assets.
You really have to remember that money on a screen is just a digital illusion. Brokerage account balances, they're literally just casino chips. The money is only truly yours the second you withdraw it. Pulling it out does so much for you. It grounds you, it resets your ego, and it physically protects your capital from whatever future storms the market throws your way. So let's wrap up with this stark reality check from Livermore's legacy. Take a hard look at your own portfolio management today and ask yourself, are you participating in the market with the mindset of a patient hunter or a trembling gambler? Look at your recent actions and decide which mindset is truly dictating your financial future.